kind enough to join us. Senator, can you hear me, my friend?
You bet I can. Thanks, Neil.
All right, I apologize for that, sir. I want to bring your attention, and you know it far better than I, that there was a lot of backstopping of SVB today, not the least of which to follow on two other banks that had similar type quasi backstops available for the depositors, well above the $250,000 per person guarantee that the FDIC typically makes. How do you feel about making that limitless?
Well, first of all, I think they were correct to step in immediately. The $250,000 was guaranteed already. And I think the logic behind going up the additional amount was to stop any further runs on any other medium-sized banks that might occur. This particular bank had a niche market. They were looking specifically at technology and healthcare startups, the venture types. They had about half of all of those insured in that they banked in the United States. So they were fairly large in that specific area. So they had some additional risk, which should have been caught by the regulators. But in the meantime, I think the fact that the Fed has stepped up and now said that they want to increase the amount of coverage up to the limits of whatever's in deposits do bring some challenges for us. I think we have to talk about how we're going to ensure that, fund that, and who should be responsible for that. I don't think that they've really answered that question yet, except to say that they're going to pass it on to other banks. I think we're going to have some more information before we decide that that's a good long-term deal.
You know, I was looking at a lot of the medium-sized banks and those that, through no fault of their own, might just get caught up in this wave. I'm mentioning First Republic, PacWest, even Charles Schwab, KeyCorp. Even some of the larger banks for a while were taking it on the chin. Is there a limit, Senator, that we should assign to institutions we essentially rescue?
Yeah, right now we have those institutions which are too big to fail, so to speak. And on those, we've made it pretty clear in the past that we're going to step in on those. Some of these medium-sized and smaller institutions that you wouldn't think would have a significant impact, but in this particular case, since they had so many of these small businesses that were growing and they were so concentrated in these particular banks, that they did become significant. And because they became significant, there has to be a plan to, number one, make sure that the liquidity is in place. I know that they're supposed to be doing a quarterly liquidity test. I think it's called the 2052 form that they're supposed to be filling out on a quarterly basis. The regulators should be looking at that. I know that Mr. Barr, who is number 2 at the Fed, has indicated that he's going to be leading an investigation to make sure that the process that they use to actually review these liquidity limits is correct. And I think that's a healthy thing to do. But I'm going to come back to one item that everybody should be aware of. A lot of this is being caused intrinsically by the fact that we've had a very fast rise in the rate of interest rates caused by this policy-induced inflation. And we shouldn't forget that. When you have a policy-induced inflation like we've got, and the Fed is forced to raise interest rates to try to get ahead of inflation, that puts some real challenges on people that are trying to manage debt or trying to look at secure investments like treasuries. And then the question comes into play, what length of time do you put your treasuries out? Do you go at very short term or long terms? And in this particular case, it sounds like this particular institution was trying to go long term, and that probably came back to bite them and a lot of depositors.
Well, do you think, Senator, there are other Silicon Valley banks out there?
Well, what we don't know is how many of them would be impacted by the same organizations that are out there looking at them saying to everybody else, hey, you ought to take your money out, and creating another run. I think what the Fed did in this particular case was to step in and say, we're going to guarantee those deposits. And as you've heard a number of your other guests on there today saying, thank goodness we've got somebody that's assuring us that we've actually got these deposits that are being protected. But the real question is going to be long term, who is going to actually pay the cost of guaranteeing those deposits in the future? And I think that's something that we're going to have to talk about. It's something that Congress is going to probably have to get involved in.
Yeah, to put it mildly. Senator, thank you very much, Senator Rounds, on that. In the meantime,